These are going to be the key risks for our part of the world. Patricia Krause, our Coface economist for Latin America, will go over this for us today. Thank you. And now I will leave the floor to our economist, Bruno.
Thank you so much, Ati. Well, good morning, good afternoon, everyone. So, yeah, basically today we'll try to understand what is happening in our regions. Well, so in my region in Western Europe. But first, we'll start by a quick view of the global outlook, which, well, I think you won't be that surprised to see that our country risk assessment map is kind of orange red, of course, because the global economy is facing an unprecedented crisis with, as you know, loads of challenges, and of course, because of this pandemic. You can see in this chart that during the last barometer published in early October, we only have 5 downgrades, but because during the previous barometer we downgraded 71 countries. So basically, well, loads of countries, almost all the major economies in the world, because as you know, all the major economies in the world are facing these pandemic consequences. There is not A1 countries anymore, so no country with a very low risk, of course, because we are talking about a global crisis. You can see that basically, despite the fact that Africa is in red, has been over the last years the most risky region. Maybe, well, it has been quite spared, let's say, by the pandemic, except maybe South Africa that we'll see quickly after. But at the same time, you can see that in Asia, it's true at the beginning, the starting point of this pandemic. Some countries are maybe doing kind of better than in the rest of the world, like China, where it all started, but now maybe, wait, I will enlarge the chart. You have to do some zoom in. So, and well, also in Vietnam, for instance, these countries which are doing quite better than the rest of the world also. But well, you can see that, for instance, the 2 major downgrades were India and also Hong Kong, because of course these countries, first for India, seem to be quite spared by the pandemic in April, May, but then of course during the summer it was one of the most affected countries, and we will see it right after with the pandemic curves. And also, well, Hong Kong, a second year of crisis, because, well, last year it was because of the protest. The protests are still ongoing, and at the same time, the country has been still affected by the pandemic. So, huge challenges for these 2 countries that we decided to downgrade during this quarter. But you can see that basically, and then Ruben and Patricia will make a focus in their regions. You can see that all over the world we have a very risky environment. Now, if we move to the curves of this wave of infections, well, as you probably know, and then we'll talk more precisely about it in Europe. In Europe, definitely you can see very clearly a second wave with these green lines growing and growing. With also in North America, Ruben will talk about that with the US and Canada, of course. And you can see here that in different parts of the world, we have different levels and we are at different stages of the pandemic. With South America, Patricia will talk about that, but it seems that in many countries, the peak, let's say, of the first wave is behind us. But you can see that in Europe, definitely, and maybe is the most worrying topic, let's say, that we have a second wave, and we see that once the summer is over, and once you lift the measures, and then during some 3, 4, or 5 months, then you have an increasing trend once again, which means probably that while we don't have any vaccine, it means that we will have stop-and-go politics, stop-and-go measures, because, well, it seems that it will be the new normal with, of course, huge effects on economic growth. And what we will see, I think, probably all over this presentation, we'll see that, of course, now the governments will try to adapt and to not harm, let's say, the economics. The economy as it previously happened, but definitely it will be very hard because once again it seems that over the next 6, 7, 8 months we don't really know precisely, of course, because it will depend on when a vaccine will be available. It seems that definitely the recovery won't be definitely full, let's say. And well, so here we show you our GDP forecast all over the world. Of course, we are talking about the worst contraction since the Second World War. It's the worst contraction in let's say in peacetime, and you can see that it's not a surprise, I think, for anyone that the most affected countries are the European ones. With Spain, Italy, the UK, France. We'll talk about all these countries right after. Also Mexico. Patricia, of course, will discuss this topic. India, which has posted the worst GDP growth at a global level, with a minus 26% of GDP growth on a quarterly basis. In Q2, South Africa too, minus 16% in Q2. So of course, these are the two countries the most affected, with Mexico in terms of emerging countries. And well, then when you look at let's say at the most positive performance, you can see that definitely China is doing better than the rest of the countries so far, with a plus 1%. Of course, it's lower than 6-7% that we were expecting by the end of last year. But well, when we think about the fact that China it's where all started, then it seems that the country has handled very well the pandemic since then, with industrial production which is recovering, which has recovered very gradually. Then, of course, I mean, now that you can see that, of course, the rest of the world will still face the pandemic and the consequences over the next months, probably new export orders for China will be still low. So let's say that the recovery won't be total in China. But still, when you compare with the rest of the world, definitely we can say that they're doing quite well. And so as a result, with all this negative growth, all these recessions, you can definitely see that our insolvency forecast, a huge increase. Here you can see the percent change between next year, 2021 and 2019, because, and we will discuss it then later, in Europe, many countries implemented some temporary amendments of the insolvency framework to prevent insolvencies this year. So, for instance, in Europe, we will have a huge fall of insolvencies this year, but we know that it's not normal. It's just a matter of time before it happens. And well, you can see that basically huge increase. Then sometimes it's quite difficult to compare the different countries because, of course, the insolvency laws are not the same, are not very comparable in the different regions and so on. But Hong Kong seems to be the most affected one because, of course, Hong Kong is the second year of GDP contraction. So, of course, the longer last a crisis and the heavier is the effect on businesses. Then also you can see in the US, in the UK, the countries where the insolvency are very reactive to the economic recession. And well, also, of course, you can see all the countries in Europe all around plus 20%, plus 30%. And we have to say that maybe it seems that it's not that much, but has for the moment, for this year, the insolvencies are decreasing, maybe decreasing by 20-30%, as I will show you after. It means that then there will be a huge increase next year because, of course, the base will be very, very low. So now, if we move to Europe, as I said, it's a very challenging environment for Europe because, of course, now we have this second wave. The second wave is absolutely huge. and is huge, let's say, in all the countries. At the beginning, it seems that it started in Spain, let's say in July and so on, and that some countries were doing quite well, and then also it got to France, to the UK, to Belgium, and to all the countries, even the countries like Italy, which seems to handle it very well. Now we see also 20,000 cases per day, 30,000 cases per day, and well, all the countries are implementing new restrictions, with in some countries some curfew, like in Spain or in Italy, with lockdowns in France, in the UK, in Belgium, let's say a soft lockdown in Germany. And we can see now that definitely it will be a stop and go policy during the whole winter, and even probably during the spring, until we don't find a vaccine. Here I show you the first GDP figures for the Q3. Let's say it's kind of a small hope, let's say, because, well, I show you on the left chart the impact of the crisis in Europe, where you can see, of course, a bigger effect in Q2 than in Q1, because the majority of the lockdown were implemented, I mean, at the end of the Q1, so during the whole Q2. You can see, for instance, in the UK, where the lockdown lasted 2 months, and 2 months until, let's say, it was gradually lifted, but until, let's say, the mid of June, and you can see minus 20%, 18%, and in the countries where there was no like strict lockdown, in Germany, Netherlands, and Switzerland, only minus 10. So of course, say only, but it's still, I mean, it's the biggest recession in peacetime in these countries too. So let's say it's still a substantial impact. And then you see the rebound. The rebound in Q3, let's say it's a strong rebound, plus 18% in France, 16% in Italy. Of course, a smaller rebound in Germany, but because the country was less affected. And you can see that all these countries were still around 4% under their Q4 2019 level, which means that basically it was their level before the crisis, so still 4% to complete. And so, well, it means that it was a strong rebound, that some countries, it's what we will see after, some sector did better than other ones. Some were very far from the pre-crisis level, but let's say that if we look at the whole economy, it was a strong rebound. Spain is kind of different, because Spain was more dependent on the tourism, for instance, and as the resurgence of the virus started very early in July, it means that the tourism in Spain was very low this year, and also, for instance, British tourists could not go to Spain, or they could, but then when they came back to the UK, they had to quarantine. And it's not hesitate, because, of course, we are talking about the first tourist in Spain, the British people. So, of course, it has a huge impact. And Spain was, I mean, in Q3, way below the pre-crisis level. But once again, it's important to then check sector by sector. And there is one country for which we have this sector by sector breakdown. So for France, but to be honest, I think that, well, let's say the positive thing of this crisis is that it's an even crisis, let's say, all over Europe. So all the European countries are affected the same way, with the same sector being also affected basically the same way in all the countries. So we can definitely learn some things from this French data. And that's why also during all this presentation, I will show you some French data, but basically the trend is the same in all the biggest, all the major European economies. And you can see here that, well, you can see that, for instance, the construction sector was very affected. You can see that it reached maybe, it decreased by 30%, but then a strong rebound, and at the end of the Q3, it was only 5% below its pre-crisis level. But then all other sectors like the transport equipment, and we will talk about it later, were still 20-25% below last year level, because of course when you talk about aerospace and automotive sector, we are talking about maybe the two most affected sector, and this impact will last in this sector and even more in the aerospace one. And then, of course, in terms of services, it's not a surprise, I think, to see that the hospitality sector was still way below the pre-crisis level, the transport sector too, because of the air transport. The air passenger demand over the first 9 months of the year was 64% below last year. It's huge, it's substantial, and of course, then it negatively offset all the rest of the transport sector. And then, if we dig more deeper into the industry, you can see that even in the industrial sector, you have different trends. We, once again, in France and in the UK, still in August, other transport equipment, which means aerospace sector, being 27% below February level. And we expect this sector to be sustainably affected by the crisis, because once again, no one expects the air transport to reach pre-crisis level before many years. Then you can see that other sectors are still affected, like chemicals, like textile, with the UK being an exception thanks to the face mask. But metal sector are also still deeply affected, because once again, as aerospace sector and automotive sector are affected, then all the sectors that depend on this demand are also deeply affected. It's what happens with metals, with plastics, and so on. Here with the automotive sector, you can see in France it was only 8% below the pre-crisis level, but it won't last. The new car registrations in Europe, let's say they rebounded in some countries in some months during the summer because of the public subsidies, but it won't last, and we've seen it, for instance, in September when they fell back in many countries. And when you look at the figures all over the first 9 months of the year, basically you have car registrations between 25 and 35% below last year level. And of course, what happens now is the second wave. So we've seen the rebound, but of course now, as there are no, let's say that the outlook is very negative for all the sectors, many sectors will have to close, the non-essential shops. This time it will be different for the construction sites, for the factories, because they will continue to operate. But anyway, the issue is that the demand will probably be very low, so they won't have these supply issues this time. They will be able to continue to operate, but at the end, it seems that this rebound won't last, because they produce to fuel this rebound and this rebounding demand. But then, of course, now that the demand will fall back, it seems that we will have a double dip recession in this country, and for all these sectors, even the sectors that will not be directly impacted by the restrictions, unfortunately, there will be then a demand effect, let's say. And you can see it here, what happened during the first wave. During the first wave, but basically it happened the same in all the major European countries, because the disposable income fell, it's true, by, well, you can see in France by 2%. It depends then on the countries, but in all the major European economies, the state has really been very supportive. I mean, regarding, we'll talk about that, businesses, but also people with a follow scheme implemented, quite generous with, for instance, in France, like 84% of the net wage are given to people, even though they could not work. So at the end, you have a lower disposable income, but only by 2%. And then, as the consumption fell by around 20%, it means that there were huge savings. And the saving ratio, which you can see in France was historically, let's say, high, around 15%, while, for instance, in the UK it's around 5-7%. Well, it increased until, you see, to 27%, which of course is historically peak. And then the question was, okay, so now maybe they will spend these savings, but when will they spend it? And it's true, when we look at the GDP figures in the Q3, some of the savings were spent, but then when you look at the consumer expectations, at the consumer confidence, you see that probably because of the second wave, because of this uncertainty, and this very likely stop and go restrictions policy over the next months and over the next quarters, the consumer will lose their confidence. And you can see that even in October, because all these surveys were conducted in early October, and already you can see this slight fell back. And of course, we can expect that in November, all these confidence indexes will fall further. And it will mean basically huge precautionary savings for the households in France, but once again, all over Europe, because all the governments are just extending all their measures, all their supporting measures. With, for instance, even in the UK, the Chancellor just announced today that the follow scheme would be extended until the end of March, and all the governments in Europe are keeping on doing the same, which is follow scheme, state-backed loans for the companies, tax deferrals, and many grants too, because, well, basically what they try to do is to support the economy, to allow it to then rebound when the vaccine will be found. But for the moment, it definitely seems that the consumer won't spend their savings because, once again, they're losing the confidence once again. And on the business side, you can see here the intentions regarding the hiring projects, the investment projects, and even in September, let's say half of the companies were planning to postpone or cancel their investment and hiring projects. But you can see, I mean, they were more positive than in April or June. And it means that definitely, because of the economic uncertainty, they will now postpone and cancel in a way higher proportion than in September, because, of course, their confidence is very related to the health situation, and we can definitely expect them to then postpone or cancel the huge majority of their projects for next year. And you can see here that, for instance, the cash flow constraints are not the main reason, despite the fact that, of course, we had a substantial fall in revenue, because once again, the European governments really fooled all the companies with these state-backed loans. In all the countries, basically, the state backed from 70 to 90% all these loans to the companies, to any company. It's true, even to the riskier one. So it means that all the companies have been able to just have huge cash flows. But of course, then the economic uncertainty that will last, and it's the major issue, will still affect the investment projects and the hiring projects. But as I said previously, so far the insolvencies are decreasing a lot in the UK, in France, but also in the other countries. You can see that the insolvencies are still 30-40% below last year level, and even in September, for instance, you can see that both in the UK and in France, the number of insolvency is ridiculously low. And as I said, I mean, it's due to many reasons. The first one are all the government support, because once again, the government helped a lot all the businesses, and they keep on doing it. And also then, all the governments voted some insolvency procedures amendments, let's say, where to be quick, people were not forced to file for insolvency, despite the fact that maybe they were in cash flow insolvency. And because, of course, the government wanted the insolvency to be only voluntary during this time. And you can see that in Germany, Spain, the UK, and Italy, all these amendments have been extended until the end of the year, and well, probably it will be extended even further. But the very interesting point is in France, where the suspension of the filing obligation expired by the end of August. So we were expecting maybe a huge rebound of insolvencies in September, and it didn't happen. It didn't happen, so it means that basically the companies were not in cash flow insolvency, which means that basically even if the companies are forced, are obliged to file for insolvency, I mean, without these amendments, they don't do it because they're not in cash flow insolvency, because they have huge cash flows thanks to state help. Then the huge question, the very important question, will be how many companies will file for insolvency because they just feel that, well, the outlook is too negative, that basically they won't have new orders over the next months, next quarters, who will say, okay, it's worth it to get more indebted, despite the fact that we don't see any market or opportunities over the next month. So now it's a huge question in Europe, because, well, so far in terms of cash flow, it seems that the companies have it, that all the support schemes are extended. But, well, once again, then it seems that probably, I mean, it will be the final throw, this second wave for some companies. And, well, just to finish, now, of course, so we talked a lot about the coronavirus crisis and, well, the pandemic effect because it's a major effect. But then, in addition, we have also the negotiation between the European Union and the UK, with the UK leaving the European Union at the end of this transition period by the end of the year. And, well, if they don't find any agreement, it means that then the UK will leave the EU in the WTO terms without tariffs and non-tariff barriers between the two blocks, let's say. And the negotiations have been as tough as expected, still loads of uncertainty, because, well, the deadline now seems to be mid-November. But to be honest, I mean, first deadline was in September, then the deadline was in early October, then by the end of October. Now, well, we are thinking that next week should be crucial, but maybe next week could, let's say, show some progress before the week after we sign a deal. So, well, let's say that the deadlines are very moving. But anyway, some very important issues are remaining still, and the two major ones are the level playing field, with basically, let's say that labor and environment regulatory alignment are agreed right now. It seems that there will be a non-regression agreement, but then on state aid, of course, the UK left or is leaving the EU because it wants to be sovereign. It wants to take back its sovereignty in terms of public policy, and so it means that basically they want to be able to give state aid to their companies, but at the same time the EU say, okay, but if you want a tariff-free trade, then you need to have a fair competition between our companies, so you should basically follow our rules in terms of state aid. They will have to find an agreement on that. And then the issue is how can you decide the sanctions? Basically, the EU, what they want to be sure that the UK will follow these laws, these rules, is that basically the subsidies will have to be approved first by the competition authority, and the UK say no. First, anyone can do whatever he wants, and then if it's unfair, then there will be sanctions. But knowing that, of course, then the sanctions can happen years after. So of course you can take some advantage during this year of let's say unfair state aid. So basically now we are talking about more technical questions, but it's still hard because both sides will have to show that, well, they are the winners of the negotiations. And then the other topic is the fisheries. It seems to be not such an important sector, but it's a totemic sector, both for Brexiters, because they want basically Europe to have annual negotiations as the other countries like Norway, Iceland, or Far East, to know the quotas that they will give us for next year. But of course, for France, it's very important too. Not for the rest of the Europe, basically, because we are only talking about French fishermen. But well, of course, France has a huge weight in the European Union. And so, well, it's an important topic, but it seems that as they don't want this, let's say, this small issue to just prevent them from signing a broader agreement, they will maybe just defer this question until a later date and sign a wider agreement. We still think that the most likely scenario is that they will find an agreement over the next weeks, because as you can see, I mean, it's so important for the UK to sign an agreement with the EU, because as you can see, it's basically half of the UK trade, and then it can have really a strong impact then on the economy. And of course, it's now not the best moment to have such a negative impact because of the pandemic. But of course, as both parts are unpredictable, and in the UK part, Boris Johnson is also very unpredictable, we cannot rule out that the UK will leave the EU without any trade agreement. And if it happens, then here you can find the duties that will be applied by the EU to the UK as to any other countries. Is the most favored nations, like say the WTO tariffs that are applied to any countries with the European Union doesn't have any trade agreement signed. And you can see that basically the European Union protects a lot its agri-food sector. Also, well, let's say the automotive sector, the clothing sector. And in red here, you see the sector where the UK will also apply tariffs. Because of course, for the UK, the question will be, let's say, to do not apply loads of tariffs, because I mean the UK has to import many goods, and so it will lead to higher costs for the British companies and also to higher inflation. But at the same time, the UK will have to protect its own industries, and mainly its agri-food industry, because as you can see, the EU is very protectionist regarding its agri-food industry. If the UK doesn't implement any tariffs in agri-food industry, then there will be definitely unfair competition for the British producers. One of the most affected sector would be definitely the automotive sector, because it's a very integrated industry all over Europe, and the UK exports more than half of its production to the EU. And once again, I mean, when you build some cars, many components can cross several times the channel. So just imagine, even if its tariffs are 3 or 5%, it would mean that 6 or 7 times 5% will make probably, let's say, the UK not competitive anymore for the automotive industry. For, of course, all the companies who want to sell in the EU. So once again, it could have a huge impact, but more in the long term. Let's say at the beginning it would only be some disruptions at the border, but of course in the longer term it could really impact the European Union, but mostly the UK in terms of productivity. And so at the end of activity. Now I let the floor to Ruben, that will talk about the US elections.
I hope you're all well. Thank you, Bruno, for your presentation.
I give you the ball.
Thank you. I should be able to use the slide. So let's cut right to the chase. The big story of the week and the hot topic of the week has been the U.S. election. And we're going to try to look at what's the impact of what is happening and what's the impact of this uncertain election.
Ruben, you are on mute. We cannot hear you.
Thank you. Hello. I hope you're all well. Thank you, Bruno, for your presentation. So let's cut right to the chase and go to the U.S. election. As you're aware, that's the hot topic of the week. And the race is still uncertain. As I'm speaking, there is no winner has been called. So far, media outlets results have called about 264 electoral college votes for Joe Biden, which seems to have a clearer path to the White House. But it's not over, and as you're aware, the Trump's campaign is already asking for recount in Wisconsin. They're asking for stop in vote counting in Pennsylvania and Michigan, and are contesting some results that have been called by media earlier. So that's why we have this very uncertain race, and we'll try to see how it impacts the U.S. outlook in the near future, and in how it's going to affect policy making in the longer run. So 2 questions for this U.S. election.
Ruben, sorry. You are on mute again.
I'm sorry. To be put on mute. As I was saying, there are 2 main questions with this U.S. uncertain election. Why is it taking so long, and what can explain this tighter race than expected? So first, the second question: why is it so tighter? Why is it a tight race while opinion polls were suggesting a very big win for Joe Biden? So one of the explanations at this stage is the huge turnout. As you can see from the left-hand side charts, the 2020 turnout is 160 million people, close to 160 million people voted in this year's election. That's about 66.8% of the voting eligible population. That will be the highest turnout in 120 years in the U.S. And this can explain the discrepancy between the 7 to 8% lead that we were seeing for Joe Biden before the election, and the 2 to 3% lead that Joe Biden would get in the popular vote as I'm speaking. To the second question, why is it taking so long? Well, the answer to this question is also on the left-hand side chart. As you can see, most of the vote that's been casted these years, and more than almost 2/3 of them, were casted early, and a huge number of them were returned by mail, which are typically taking longer to be processed and counted. So that's why we don't have the results yet, and it might take still a few days before media outlets can call a winner. Hopefully, we'll have a clearer view by tonight with the results in Nevada and Georgia expected today, and it might be that Biden might get the 260 votes. And what is important, and what explains also that the race has been changing so fast, is what you can see. It's a huge discrepancy in how Republicans and Democrats vote in this election. As you can see on the right-hand side chart, and as suggested by early votes, it seems that in-person votes was in favor of Republicans. So that what you can see in a certain number of states on the left with the left bar, but there's a huge majority of votes being casted by mail that are heavily for Joe Biden. So that's what explains that the race in Michigan, Wisconsin, has gradually shifted towards Biden as votes were counted and as mail-in ballots were counted a bit slower. But with these results and with this very tight race, it seems that we are going to have disputed elections. So what happens and what's the calendar if the elections are disputed? So let's look first at what happens in the upper part of this slide. So as you can see, on November 3rd, it was election day, the day on which people typically vote. But you can see that different states, they have deadline for absentee and overseas ballots that can extend up to 14 days. So it means that they will, in some states, for instance in Illinois, they will continue to receive ballots that has been postmarked on November 3 up until 2 weeks after November 3rd. So it can make a difference in vote counting and in the color of the state. Another key aspect is that before the electoral college can vote and can designate who is the winner of the election, of the presidential election. Well, there is deadline for states and for states to certify results. And as you can see, it goes up until December 12th, so right 2 days before the electoral college actually casts their votes. So this period is very open to uncertainty. And as we've seen, with the reaction of the Republican campaign and of Trump campaign, there are going to be challenges. And in the first part, when the challenges in the U.S. is going to be legal challenges and lawsuits being filed in several states. The first step in lawsuits for this type of for general elections in the U.S. is that state courts will have to decide whether or not votes are valid, whether it requires a recount, et cetera, et cetera. So if the Republicans do not concede defeat, and if Joe Biden is elected, and if Republicans do not concede defeat, well, it's likely that we'll have lawsuits, and it could extend uncertainty over who is going to be the next president for more than a month. So that's a very uncertain period that is going to probably weigh on business and consumer confidence at a time that is already very difficult for the U.S. economy. And what happens if because it's still an open scenario. A key question is what happens if no candidate gets 270 electoral college votes. So that would happen if there's a tie at 269 for each candidate. But it could also happen if after lawsuits, courts decide to invalidate some results. So what happens then? So it's pretty simple. It's Congress who decides who is the next president and who is the next vice president. More specifically, it means that in this scenario, the House of Representatives would pick the president based on state delegations majority. So it means that in this scenario, if no candidates can get the 270 electoral college votes, it could possibly be favorable to Trump's bid for re-election, because the Republicans, even though they don't have an individual majority in the House of Representatives, they do have the majority of state delegations. So that's important to note. These are the scenario and what is going to be in the discussion in the next 2 months, and it could go up until the beginning of 2021, up until the joint Congress session of the new Congress being elected, certify the final results that we don't have a clear winner to the election. That's a potential scenario. But currently, our main scenario is that Joe Biden will be declared winner by media outlets and by the first count, but that there will be legal challenges that will drag the uncertainty until at least the beginning of December. And it is very important and it has very deep implications in terms of economic policy, because Joe Biden, the Democratic candidate and former vice president, and Donald Trump, the current president, have two very different paths in terms of economic policy making. So the first difference is in terms of COVID-19 management. So one of the key differences in the support that they want to provide in terms of economic policy in the near future to support the economic recovery is that, for instance, Joe Biden and Democrats are pushing for aid to state and local governments and are pushing for very, very heavy fiscal spending to support the recovery. On the other hand, well, Donald Trump, even though he's been supportive of more fiscal spending, he's been facing some resistance from deficit hawks within his own majority that has been delaying the further passing of a new fiscal stimulus bill in the U.S. and is threatening to delay the recovery even further in the U.S. There are other key major differences in terms of economic policy. One of the main differences is on fiscal stance. As you know, Donald Trump in 2017 cut taxes very aggressively, and notably cut the top corporate tax rates from 35% to 21%. So it supported companies' profits and has been supportive of economic activity. Joe Biden in his plan, wants to roll back on these tax cuts and is planning to raise the top corporate income tax rate from 21 to 28%. So that's one of the main differences that could shape the future of economic policy. Another key aspect and key question in the months on which depends the result of this election is what happens in terms of trade policy. With Donald Trump, we've seen a rise in trade tensions globally, and particularly with China. With Joe Biden, he's indicated, and if Donald Trump is reelected, it is likely that we'll continue to see very high trade tensions at global level. If Joe Biden is elected, he indicated that he was open to a more multilateral approach and to more dialogue than his Republican counterpart. But our scenario is not that we'll see a huge detente in terms of trade policy, even if Biden is elected. You're probably aware that Joe Biden has been very critical of China trade practice and has expressed concerns over China's trade practice. So he might maintain some kind of pressures in terms on China in the near future. And we are not likely to see a sharp fall in tariffs between the U.S. and China in the very short run. Long-standing trade tensions are also likely to continue under a Biden administration because, for instance, the tensions surrounding subsidies over airlines is a long-standing tensions and was there even before Donald Trump was elected. Also, Joe Biden has already indicated that re-entering into a dialogue for new trade agreements was not a priority. So yes, there are some differences in terms of Joe Biden and Donald Trump's economic path, but as you can see, some changes might take some time. And also a very important aspect of policymaking, and that also hangs on the result of these elections, is what will be the color of the Congress. As I'm speaking, it seems that the Democrats are going to be able to retain the House of Representatives, but it also seems that Republicans are going to be able to retain Senate. So it means that in any case, and whoever is elected president, it will translate into a split Congress and divergence between the White House and Congress. So it might slow policy making and notably discussions surrounding a fiscal stimulus. Which brings me to where is the economy and the U.S. economy actually and currently as we're speaking. So like in Europe, it's been deeply affected and deeply impacted by the COVID-19 crisis. As you can see with the green bar charts on the left-hand side of the graph, GDP fell by 1.3% in Q1 and 9% in the second quarter of 2020 as a result of the lockdown being implemented. On a side note, you can see that this collapse in GDP growth, which is an historic flunk for the U.S. in terms of GDP growth, is still lower than in most European countries. This is because lockdown measures were less stringent as a result of a wide variety of response between states during the lockdown phase. You can also see that just like in Europe, we recorded in Q3 a record rebound in GDP. A 7.4% quarterly increase was recorded in the third quarter. That's a record. That's a positive news. But on the left-right side, what you can see is that the recovery is not complete. That's what you can see with this blue line on the left-hand side chart. it suggests that the U.S. GDP is still 3.5% lower than it was before the crisis. And this recovery is not being complete. It's even clearer when we look at the state of the labor market. You can see that as of mid-September, the level of employment was still 7% below the pre-COVID level. And you can see that there's still a very long way to go. Back in 2008, 2009, with the great financial crisis, at the nadir of the crisis, you can see that with this green line, that it was reaching about that employment was at worst 6% below its level, and it took up to 5 years to return to the pre-recession normal. So in going into the future, it might take longer to recover for the U.S. And this is suggested by high frequency indicators. As you can see with this left-hand side chart, both consumer spending and small businesses open. After they rebounded quite sharply in the first phase of recovery, you can see that progress has been much slower since mid-June, basically. And this is particularly stark for small businesses open, and this is also because of the health situation not being in control in the U.S. As I'm speaking, the new cases are still rising in most states. 43 states were recording new cases increase as yesterday. And they were recording at the national level, they were setting new records of new daily infections, close to 100,000 infections per day. So that's a worrying signal for the outlook, and that suggests that going forward and as we move forward, the recovery will be slower. And what it means is that we will probably not recover to the pre-COVID levels before 2022. So it might take still up to 18 months before we can go back to the level that we had in 2019 and to the level of activity that we had in 2019. And even if we go back to the levels of activity that we had prior to the COVID crisis, what is important to know is that there will be very different paths by sector. And that's already suggested by figures in industrial production, for instance. You can see that there's a wide variety of recoveries in different sectors. You can see that the oil and gas sector and drilling in oil and gas is not recovering at all, and is probably going to continue being in a difficult state. Metals, the clothing industry is also in a very difficult position in the U.S. On the brighter side, you can see that communication equipment, electronics, pharmaceuticals are faring way better. In the middle of the pack, and that's something to know, the auto sector has recovered pretty strongly and more briskly than in Europe. But there are a lot of questions if this rebound that we've seen in Q3 is sustainable, especially as figures in September were less optimistic than in the first months of the recovery. So we're going to have a slower recovery going forward, and it's going to grow more and more uneven when we look at it by sector, by sizing companies, with SMEs likely to be more impacted by this crisis than large corporations, and also by income levels. And that's why fiscal stimulus is so important for the U.S. and further fiscal stimulus is so important. The major piece of legislation in terms of fiscal stimulus to support economic recovery in the U.S. Was signed by President Donald Trump in late March. And as you can see with the left-hand side chart, it contributed to a huge increase in the federal government budget deficit, which has reached at the end of the last fiscal year more than $3 trillion US. So this is an unprecedented response, and with fiscal stimulus that has amounted to about 14% of U.S. GDP. This is huge, and it has provided support to households. You can see that with the right-hand side chart. You can see that despite the crisis and despite many people being furloughed, as a reminder, the unemployment rate jumped to close to 15% in April. And you can see that despite this rise in unemployment, we've seen a rise by close to 15% in disposable income in April. And it was mostly supported by this blue bar, which represent governmental social transfers to households. But you can see that since then, well, the support of governments has been declining, and that the income of households has started to decline. And this is especially, I want to focus on the August level. It's really interesting because in August, the top-up federal unemployment insurance expired, and you can see that it translated into personal disposable income falling by close to 3%. So this is likely to translate into lower consumption going forward. And as you know, consumption is the main driver of the economy in the U.S., representing about 2/3 of GDP. These economic measures were also very important for businesses, and it is suggested by data in terms of bankruptcies. You can see that with tax deferrals being passed, well, the number of big bankruptcies recorded in April and May trended downwards, and with U.S. business courts, bankruptcy court being closed, it's also helped to keep business bankruptcy on a downward trend. You can also see from this chart that there's been no surge following the reopening of the economy, even though there's been some increase, but no surge in terms of total business bankruptcies in the U.S. And this is probably thanks to the support of the fiscal stimulus, with a lot of guaranteed loans being given, tax deferrals, as I mentioned, and also support from the Federal Reserve, with a lot of liquidity being injected into the market. But when we look closer at the bankruptcy figures in the U.S., there are some worrying developments that suggest that we could see a rise and a wave of bankruptcy in 2021. You can see that in the first 9 months of the year, and if you look at the gold line, in total bankruptcies fell by 2.2%. So this is surprising considering the extent of this crisis. But if you look at the contribution for the different type of bankruptcies, you can see that Chapter 11 bankruptcies, which represent restructuring proceedings, they've increased by 33%, which is huge. And there's a chance that 30 to 40% of these Chapter 11 bankruptcies will transform into liquidations in 2021. So Chapter 7 bankruptcy, which so far has trended downward and has helped to bring the total number of bankruptcy down. So no wave of bankruptcy yet, and that's somehow positive, but we should be being cautious because there are some worrying signals. And in terms of sectors, what we're going to see, and we'll already see very big divergence and a very big divide in terms of sectors. So in the red, and contributing the most to the rise in new bankruptcies, along with the energy sector that I mentioned earlier, is the retail sector. So just like the energy sector, the retail sector was in a difficult position and was in crisis prior to the COVID-19 pandemic. You can see that in 2018 and 2019, the number of retail bankruptcies were trending upward. And it's been obviously exacerbated by the shock for retailers, and especially for department stores and closing retailers. On the brighter side of the story, big box retailers such as Walmart and e-commerce has surged. So obviously Amazon has been faring pretty well during this crisis, but they are an exception. And in terms of bankruptcy, we have already seen a huge number of bankruptcies being filed in the retail space, and it is likely to continue in 2021. On the brighter side of the spectrum, we have construction, and more specifically, residential construction. As you can see with this chart on the right-hand side, building permits in the U.S. has reached a record level in the last few months, and in September. It's a 14-year high, and it has never been that high. It has never been that high since 2006. Why is that? Well, with the pandemic, demand has shifted, and more people are reconsidering their homes needs and their residential needs as they have to work from home for longer. But one of the key drivers of this recovery in the residential construction sector has also been lower mortgage rates. You can see that with the green line represented on this right-hand side chart. And you can see that mortgage rates at 30 years are lower than 3%. And it has supported a huge increase. But as I mentioned for the auto sector, it's very true in the first phase of the recovery that we've seen a very sharp rebound. But we do have a lot of questions going forward for these sectors because, well, we've seen input prices increasing, and notably wood, increasing and putting pressures on margins for building contractors. We are also worried because in the first phase of the recovery, high income households were most susceptible to buy new homes. But what about low income households in the months to come? Will they be able to support and to continue to support the recovery in the months going forward? And it also echoes other difficulties in the construction sectors in the non-residential segment, because we have a lot of questions surrounding commercial developments in the U.S. because less office space is demand will mean lower commercial constructions being started. And also, there are a lot of questions surrounding infrastructure. And again, it brings us back to the result of the election. Joe Biden has indicated that he wanted to invest about $2 trillion in infrastructure in the next 4 years. That would be a huge boost for the construction sectors and industry in general in the U.S. But if it does not have, if the Democrats do not have a majority in the Senate, it's likely to be difficult in terms of policymaking to pass an ambitious bill in terms of infrastructure. And we've seen in the past 4 years that Donald Trump had already struggled to pass an infrastructure bill. So that's why we remain cautious on that sector, despite positive developments. With these last few words, I will leave the floor to Patricia Krause for the outlook on Latin America, which, as you're aware, depends very much on the U.S.
Thank you, Ruben. Now we're going now I can say good afternoon to everyone, I think so. We're now going to move to Latin America. So first we'll start recalling our country risk map with the 8 different assessments, so the best A1 and the worst E. So here we have the historical evolution of the country assessment in Latin America since the Q1 2019. So during the first 2 quarters of the year, as you may remind, we implement many changes, 7 downgrades in the first quarter of the year, followed by other 3 downgrades in the second quarter. But now we remain broadly stable for the major economies in Latin America. So this was a consequence of the COVID-19 outbreak. A similar picture is also painted for our sector barometer for Latin America. So after several changes that we implemented in the first 2 quarters of the year, this time, the third quarter, we only did some marginal changes to be more clear. We upgraded the agriculture sector in Brazil from high risk to medium risk. And well, one of the factors that certainly agri-food is more resilient during the crisis, but additional to that, we have the fact, for instance, that the aid for informal workers given by the government until the end of the year is also supporting supermarket sales in the country. Moreover, we have also a very positive crop this year and good perspectives for the next year. And finally, a very strong demand for Brazilian agri-exports, notably coming from China. Contrarily, we downgraded the paper sector in Mexico from medium risk to high risk, and this is related to the lower international pulp prices, also the behavior of the paper and related sectors, industrial production improvement during the year, so with a contraction year to date. And finally, the impact of the strong crisis on small business like stationers, which are strongly impacted, notably to the fact that the government is taking almost in the absence of measures to try to remove the negative effect of the crisis in terms of business. Then here, moving to here we move to our COVID-19 evolution in Latin America. So the evolution for the largest economies of the daily new cases and new deaths. So as you know, Latin America became an epicenter of COVID-19 during this crisis. And but now we started to see some countries with reduction or flattening the curve. But despite that, we still have a large number of cases in the region. We have some particular cases to be mentioned, like the case of Argentina. Argentina was initially well in controlling compared to other countries, but then we started to see a late surge in the number of cases. Now, finally, we started to see some signs that they may now finally flattening this curve. In Colombia, we see some signs that they may start to increase, so the government also decided to end some selective quarantine until December 1st. In Mexico, we had in October the second worst month for COVID-19, and the curve also showing some signs that may be increasing. And finally, we also have the case, for instance, of Peru, which is now finally reducing the curve. But anyway, still have one of the largest death per capita ratios of COVID worldwide. And so this means that we will continue to need to monitor this very closely, especially when we see other regions that were more effective in controlling the COVID-19 now facing a second wave of cases. So here we also we mentioned the evolution or the spillover effects of the COVID-19 in terms of economic activity, and we compare the evolution of economic activity in Latin America with the groups of emerging economies. So we compare a group of emerging economies in Asia and with emerging economies of Europe and Africa. So figures until August, we see that Latin America, the quarterly growth in August was still lagging behind Asian and this group of Europe and African countries as well, so still dropping by 2%, while we saw Asian growing like 8% in this period. So still behind. When we break down to the main economies of Latin America, the 7 largest economies. So in the first chart we have this evolution for this country, the monthly activity evolution, while in the second chart we also compared the level of activity in August, so the last available figure, with the level of activity in February. And so how this has varied. So the February, the last month before the COVID-19 impact. So generally what we see is that Brazil is leading this process, so with a stronger rebound in terms of economic activity. Basically, this is also sustained by the strong fiscal stimulus that has been implemented by the government. Then for Chile, for instance, that's the only country where we have figures for September. We started to see some improvements as well more recently in the last 2 months, due to, for instance, the continuity of the reopening of the economy, with also high copper prices, international prices, and finally with the withdrawal of pension funds that also contributed to improvement of a rebound of retail in the last 2 months. In Mexico, activity in August was 7%, 7.4% below the level of February, but it's worth reminding that the economy was already in a recession before was impacted by the COVID-19. And finally, all the other economies are still well below the level of February, so double-digit drop compared to the level of February. Yeah. Then when we look to the export figures for Latin America, well, we have also a very different kind of behavior. Although all countries are observing a drop in exports year to date, the pace of the drop, the deep of the drop is different, and commodity prices help to explain the divergency between the behaviors. So we saw a higher resilience of exports from Brazilian export and from Chile. In Brazil, due to the agro export, while in Chile due to the export of minerals, so more resilient copper prices. Contrarily, we saw a higher drop in exports in Ecuador and Colombia, related to as well as the sharp drop in exports in energy prices now observed. And more recently, we started to see again oil prices reducing again. This means that exports should also take longer for these countries to recover. While in Peru, the country was impacted exports, while it's also very highly dependent of mineral like Chile, the fact that they have a very strict lockdown and also mining activities on a standstill for a long period of time also delays this recovery rhythm when we expect improvement ahead. And finally, Mexico is the only country have a different dynamic and more related to the manufacturing export to the U.S. And now we see a more clear rebound in the last month due to stronger demand coming from the U.S. for manufacturing goods and especially for non-automotive manufacturing goods, which expect to continue in the coming months. Looking for the preliminary figures for October, here we have the PMI survey. So we have the figures available for Brazil, for Mexico, and for Colombia. Interesting to note that Brazil continues to outperform this recovery compared to the other economies. In Mexico, when we look at the PMI for manufacturing, for the first time, it surpassed the 50-point threshold, which separates a contraction of increase of expansion. So after 16 months, finally, we saw an increase in manufacturing in Mexico. And it's also interesting to mention that the dotted lines that we have are related to the service activity in Brazil and in Mexico. And in both countries, they are outperforming the recovery in manufacturing. This is something already expected, and that's not only happening in Latin America, but everywhere. The fact that we still need to have some social distancing measures also means that service will take longer to recover. So that said, here we have our GDP growth forecast updated for Latin America. So we're expecting a stronger recession for Latin America of 8.3% for this year compared to our forecast for the world economy. For the next year as well, we're expecting a partial rebound of 3.2, which is also below the partial rebound expected for the global economy. So among the economies, we expect that the strongest contraction to be observed in Peru, with a recession of 14% for this year, then followed by Argentina, so moving to the third year of recession in a row with almost 13% contraction. Then a similar drop we expect for Ecuador and Mexico. In Ecuador, also affected by the lower oil prices and the limited space for implementing fiscal stimulus. And while in Mexico, we have the stubbornness of the government to implement fiscal stimulus to try to smooth the negative effects. Then in Chile and Colombia, similar growth rates, 6.5 and 7. And finally, Brazil is the only country where we, in the last quarter, we decided to upgrade the GDP growth forecast. Previously, we were expecting the economy to drop by 6.5, and now we're expecting a recession of 5.5, basically because we saw this better than expected figures in the last month. So that said, we are only expecting the economy to partially rebound from the level of 2020. And this, generally speaking, when we put in a broader picture, and here in the first chart we have a group of 30 countries of Latin America, we compare the level of activity that we expect by the end of 2021 with the level of activity that was in the end of 2019. So generally, we expect all the economies to still be below the level of before the crisis. We have only some marginal sections like in Paraguay, Guatemala, or Peru that would be close to the level of 2019, and with only one clear exception, that is Guyana, that is really a case apart, favored by a windfall related to the discovery of offshore oil fields in the coast of Guyana, so in 2015, and in the exploitation of the oil sector since then. And more than that, going beyond, another important point to be mentioned relates to our expectation in terms of GDP per capita evolution. So we believe that GDP per capita may take even longer to recover from the level of 2019. So here we have in our baseline the GDP per capita level in 2019, in evolution, what we expect for the largest economies in the coming years. So mostly for most of the economies, we expect to recover the level starting on 2013. So it's really going to take longer, and we are even talking about GDP per capita in local currency. I'm not talking about GDP per capita in US dollars. Another important point regards the job market in Latin America, because we have some structural features that are really important right now. In the first chart, for instance, we have the share of employment in contact-intensive sectors. So this unprecedented crisis required this border closure, social distance, kind of measures that mostly impacted sectors like hospitality, entertainment, sectors that will take long to recover. They are contact-intensive sectors. So when we compared, for instance, Latin America with a group of, for instance, of low-income countries, of advanced economies or emerging economies, all are better positioned in Latin America in this point. And although it varies across countries, so in Latin America, anyway, we see that Central American countries or Caribbean countries, they are more vulnerable because it depends more on tourists. Anyway, all the countries you see that they are generally weakly positioned in this terms. Well, we have Caribbean countries, for instance, although some of these countries were not so strongly hit by the COVID-19, but they were indirectly impacted because tourism is not recovering in the same rhythm. Although they are reopening and they are trying to promote advertisements to try to attract tourists again, well, they will not totally return until we have a final and best solution for the COVID-19. A similar picture is also when we consider the second chart. So in the second chart, we have the share of workable jobs in Latin America. So again, we see that this ratio is below, generally lower than the global average. So the position is weaker than what we see in advanced economies, emerging economies in Latin America. And so this could also impact the recovery of job market ahead. Finally, we have our political risk model. So we just updated this political risk model, Coface political risk model. And additionally to the political and social fragility index, this time we also added COVID-19 components. And these COVID-19 components, they take into account factors such as the deaths per capita or cases per capita, and the stringency measures taken by the government to try to protect the population of the COVID-19. So here we have the combinations for a group of emerging economies. So the upper right hand side shows the most likely countries that could experience a new round of social unrest. And it's certainly a really important topic for us in Latin America since, well, we had already before the crisis, we had a round of social protests in the last quarter of 2019. And certainly the pressures will rise now, as we mentioned before, with GDP per capita, GDP taking long to recover, GDP per capita taking even longer to recover, with the futures of the job market. So this means that the risk will remain high, will remain elevated. It's something that we need to monitor. And here we highlight some points per country, like in Argentina, we have the deep recession and that restarted in 2018. So poverty rate reached 40% in the first half of the year. So really strongly increased from the 27% level that was in the first half of 2018, so before the crisis. And in Brazil, we have the fiscal stimulus that help in the activity, but this really needs to be dismantled next year because public debt is rising very fast. To also have an idea, it was in 77% of GDP in February this year, and now it's in 9%, taking into account the figures of September 2020. In Chile, we have the rewriting of the constitution that was a demand from the social unrest of last year, but that will take very long. So the environment of uncertainty will remain at least until the mid of 2022, when it's expected another referendum to ratify this new constitution. In Colombia, we have the rising violence, actually abuse of police as well, also violence related to former FARC members. And that's also the population angry about that, and also with some increase in not disruptive, but we saw an increase in protests recently. In Ecuador, well, it's reached a new agreement with IMF, but it's considered a very bitter medicine for a part of the population, right? As one of the requires that they demand a rise in the value-added tax. Yeah, so it's not a popular topic. In Mexico, we have the lack of fiscal stimulus to try to protect the most vulnerable and enterprises. So it's really going to take a sharp drop in GDP per capita. And finally, in Peru, we have a very volatile political environment. So now President Vizcarra is facing a second impeachment motion in less than 2 months, and although we expect him to remain empowered to pass this impeachment process, anyway, this means that the political environment will remain very turbulent in the near future. So these were the main points from my side for now. So thank you for your attention. I will now leave the floor to Carolina, who will open our Q&A session. Thank you.
Thank you, Patricia. Thank you, Ruben. Thank you, Bruno. So let's start here with some questions that I received. The first one is from Ruben. Ruben, why is there a difference in the information provided from TV channels? For instance, yesterday some channels reported like 264 districts to Biden and others gave 253. Why is there this difference in the information?
So traditionally in the U.S., media outlets call the results first before they are officially announced and certified through November up until the Electoral College vote. So that's why these are estimates based on projections that media do based on partial results. And as you know, there are some media are more cautious on some states. For instance, the Trump campaign that said that Arizona was not, it has been called by several media, but the Trump campaigns argue that the race is still too close to call. So that's why we see these divergence between media.
The diversities. Okay, thank you. Well, the next question is for Bruno. Bruno, what effects do you expect the new lockdowns throughout Europe will be?
It will depend on the form this lockdown will take, but it seems that this time it will be softer. And for instance, let's say in France or in the UK, during the first one, all the non-essential shops were closed, but then also the rest. I mean, you were not able to go to work. For instance, in France, the construction sites were closed, the factories were closed. And this time, it's just that you have to work from home if you can, but if you can't, you have to go to work. So it means that the factories remain open, well, schools also. The schools remain open, so it means that that parents won't have to take care of their children. So it means that they will be able to go to work. While during the first lockdowns, everyone has to stay home to look after the kids and so on, and because everything was closed. This time, basically, only non-essential shops and all the venues are closed, the rest remain open. So it means that we won't have such a supply shock, but then we'll have still a demand shock. So it means that basically the sectors won't be affected the same way, and the sectors who can still run, can still operate, won't be affected, let's say, to some extent. They will be affected then in a second round effect because of lower demand, but not in terms of, let's say, of closure, or because of administrative closure. So we expect basically a softer effect, but still kind of a hard effect, but softer than the first lockdown.
Okay, thank you. The next question is to Patricia. Patricia, in your opinion, which will be the impact for Latin America countries if Trump or Biden won the elections in each of?
Okay, so assuming that a victory of Biden is confirmed, I would see three major channels of impact to Latin America. One comes from trade, and certainly the main impact is Mexico due to the strong relations. So when you talk about a change of power in the relation with Mexico, we will first expect this something positive, as we know that Trump has a very aggressive approach towards Mexico that's related to the USMA agreement. But on the other hand, Democrats they may push for a stronger compliance with labor and environmental law, and this could be within the USMCA. So this could impact Mexico. Another point, they can also question it. The measures taken by the government to give a preferential treatment to their local state-owned companies, the energy electricity companies, Pemex and CFE, right? And also saying that this is giving not complying to the USMCA rules. Another point regards the climate change. So we expect also a change from the position of Trump in terms of climate change, and this means that this could cause frictions with the Brazilian government, right, due to the deforestation in Amazonia. Before, Trump didn't care about it, and it's not a topic that Bolsonaro likes, and this could cause some kind of friction. We have also the energy topic. So Biden has also said that he would give a stronger role to the development of renewables, and this means that in the medium term this could cause downward pressure to energy prices, and this could impact countries like producers currently in Latin America. So in this group we have Venezuela, we have Mexico, Colombia, and Ecuador. And finally, the fiscal package, a new fiscal package in the U.S. The major impact would be to Mexico, as like 30% of Mexico's GDP are exports going to the U.S. So there's a huge impact. So stronger activity in the U.S. means that this tends to improve activity in Mexico. And this effect is stronger to Mexico than the other economies. Like when we consider other major markets, like the competitiveness of exports to the U.S., it's like 5% or less than that. So it's basically Mexico.
Okay, thank you. Ruben, how might the U.S. economic change if a COVID-19 vaccine becomes available in 2021? How soon after can we expect economic recovery?
There's two questions, because it's not only about when the vaccine will be validated, it's also when will it be widely distributed and available to everyone. And I think this question is not only for the U.S., it's also for the rest of the world. And in our opinion, this is very unlikely that even if a vaccine is approved by the FDA, so the Food and Drugs Association in the U.S., before the end of the year, it would still take months before all households get a vaccine. And it means that the recovery would not take place before at least mid-2021, and the reopening process, the full reopening process, before mid-2021. And a lot of the stance of the U.S. on that issue will also depend on the result of the election. Donald Trump is pushing for a very aggressive reopening because he's considering that the economic cost has been already very high and that it's necessary for America to reopen. But Biden is more cautious. And so if there's a vaccine, if it's a Trump presidency, well, it's likely to go very fast in 2021 and to as fast as possible. It will push for states to reopen as quickly as possible. But if it's Biden, there's a chance that he will probably have a more cautious approach on this topic and wait for the vaccine to be available to everyone before more aggressive reopening.
Okay, thank you. Bruno, can we consider that Sweden, who didn't implement any lockdown, are better compared to lockdown countries such as France or Italy?
You mean? Or in
Yep.
health terms? Yeah. Well, yes, of course. But we've seen it that even for instance, when we compare, the impact of the crisis in Q1 and Q2 between European countries, we've seen that Switzerland, Netherlands, and Germany, which decided to not implement a full lockdown, like Italy, Spain, France, or the UK, they were affected, but they say that the recession was the half of the one in these most affected countries. So of course, yes, Sweden did better, was less affected than the other one in economic terms during the first wave. Then now we'll have to wait for the winter and next spring. But of course, there is definitely a huge correlation between the stringency of the measures and the economic results. So yes, of course, they are doing better than France or Spain or Italy so far.
Okay, thank you.
Also, I think it's very important to compare then when you look at the health situation in the countries, also the density, for instance. That's why also Belgium, which is one of the most dense country in Europe, with Netherlands, for instance, Belgium is one of the most affected country by the COVID-19. And well, of course, the density in Western Europe cannot be compared with Sweden or with Scandinavian countries. That's why also, despite not that stringent measures, they don't have that many cases, let's say. I mean, situation is not comparable.
Comparable. Okay, thank you. Patricia, according to Coface's forecast, when Latin America will recover its GDP to the level before the pandemic? And what will be the first sectors to rebound?
Well, as I mentioned during the presentation, we don't expect the economies to totally rebound, fully rebound next year. We understand that this will take longer. It will take at least until 2021 or 2023. So I would say between 2022 and 2023 to most of the economies. In terms of sectors that will recover faster than others, first I would highlight the sectors that were more resilient to the crisis, like the agri-food and pharmaceuticals, because they were already more resilient to the whole crisis. Then another factor, the sectors that were also benefited by the stronger recovery started in China. So this year we have mining activity, so this could favor copper activity, for instance, in Chile and in Peru, or the iron ore in Brazil. And then as well, we have also a tendency of development of renewable energy in the region. Despite the fact that we have now very low oil prices, I understand that it's a long-term investment. Also, we have a reduction in the cost of developing renewables. So countries will continue to invest in the upcoming years. Well, here I'll only give the exception of Mexico because of the controversial measures taken by the government. This goes against negative for private investment in the sector, but for the other countries. And finally, we saw also an improvement in retail in some countries more recently. Well, in Brazil, the aid, the stimulus measures, also in Chile, and more recently in Peru in the last 2 months, I would say, also due to this allowance to withdraw resources from the pension fund. But these are temporary impacts. So we need to see if this will sustain after that, also in the case of Brazil, because we need to be dismantled by the end of the year.
Okay, well, thank you to all of you for participating in this webinar. I hope we've provided relevant insights for you. There are some questions that were not answered due to the time, but we will contact you directly with answers. And as I mentioned before, you will receive the slides presented today. And if you have any doubt, our commercial team is ready to support you. So please don't hesitate to contact them. Thank you all. Have all a good day.
Thank you very much.
Thank you.
Thank you. Bye-bye.
Well, thank you for your time.